I'm Kurt Walton in Narrate's headquarters in Washington, D.C., and I'm joined today by John Worth, Narrate economist. Welcome, John.
Thank you.
Today we'd like to talk about Wilshire Associates research, new research, on the role of REITs and listed real estate equities in target date fund asset allocations. This is research that was sponsored by Narrate. But why don't we open by talking about why Narrate sponsors research projects?
Absolutely. Narrate is always sponsoring research that tests the REIT value proposition and is therefore valuable to the investment marketplace. This study in particular with Wilshire Associates looks at the construction of an optimal portfolio in the context of a target date fund. And one of the things that you see when you look over the scope of Narrate's sponsored research is the consistency. Across researchers, across data sources, and across time periods, consistently this type of research finds that the optimal allocation in a portfolio includes a very meaningful share of REITs, typically around 20%. This study, looking at REITs in target date funds, finds that at the 40-year horizon, REITs make up over 17%, close to 18% of the portfolio, and even at the time of retirement, REITs contribute up to 8% of the portfolio. So a very substantial share.
And why the focus on target date funds?
Well, target date funds are the fastest growing investment products in the defined contribution universe. That includes 401k plans used by corporations, 403b plans used by educational institutions, and 457 plans used by governmental entities. In fact, many experts expect that within a decade, target date funds could hold the majority of DC plan assets. So it's very important to think about the optimal allocations within this type of investment vehicle. And today, most target date funds have some REIT allocations, but our research suggests that those allocations are far below what would be optimal according to this type of research.
So what are target date funds missing when they're underallocated to REITs?
So as the graphic shows, the new Wilshire study suggests a meaningful allocation to REITs across the glide path. That is, from employees who have 40 or 50 years working years left, actually into retirement. And one of the things that the study shows is that looking back across the last 40 years, a portfolio with REITs outperforms a portfolio without REITs and has lower risk.
So what's the intuition behind these results?
The bottom line is that these results come about because real estate is one of the three fundamental asset classes. When we look at the investable universe or the market basket, we find that commercial real estate or investable real estate makes up over 20% of that universe. And because real estate is a fundamental and unique asset class, it has different drivers than stocks and bonds. And the implication of those different drivers is that the long-term correlations between real estate and REITs and stocks and bonds tend to be quite low. That low correlation means that REITs make a good diversifier in a portfolio. Add to that REITs have provided total returns that outperform the stock and bond indices over the long term, and you're going to find that REITs make up an important part in an optimal allocation.
John, thanks again for joining us today.
Thank you.
For more on the Wilshire-sponsored research study and other sponsored research, please be sure to visit REIT.com. I'm Kurt Walton.